Welcome to the world of economics, where the numbers tell the story. Today, we're diving headfirst into the escalating oil prices that are rocking global markets. Recent tensions in the Middle East have set the stage for a dramatic surge in oil prices. The World Bank has sent out a warning that these prices might just exceed $100 a barrel. This isn't just a number on a page, it's a ripple effect that could lead to increased inflation and force central banks to maintain high interest rates. The average price of Brent crude is already hovering around $87. Any disruption in the oil supply could push these prices even higher, impacting global inflation and driving up prices of natural gas, fertilizers, and even food. The rising investment in green technologies is also playing its part, leading to increased prices of key metals like copper and aluminum, both essential for clean energy infrastructure. But what's driving this rise and what does it mean for us? Let's delve deeper. The Middle East, a region known for its oil production, is currently a powder keg of tension and conflict. Its political turmoil has been reverberating globally, particularly in the context of oil prices. A recent explosion at a Gaza hospital has jacked up these tensions further, causing oil prices to surge. Brent and West Texas Intermediate prices rose by 2%, reaching nearly $92 and $89 a barrel, respectively. This blast, resulting in around 500 casualties, has been a point of contention. Hamas attributes it to Israel, while Israel claims it was a misfired rocket from Hamas. Regardless of the source, the reality is that this conflict, even though neither Israel nor Palestine are major oil producers, has already begun impacting oil prices. The concern is not just about the immediate parties involved in the conflict, but about the potential ripple effects. Major Middle Eastern oil exporters like Iran and Saudi Arabia could be drawn into a wider conflict. The possibility of this happening is causing a stir in the global oil market, as any disruption in the oil supply from these exporters could send prices soaring even higher. The role of the United States in this situation is also under scrutiny. As the world watches, the response of U.S. President Joe Biden could significantly influence the direction of oil prices. Analysts suggest that if tension in the region is not eased during his visit, oil prices could continue their upward trajectory. The Middle East conflict is undoubtedly a significant factor in the escalating oil prices, but it's not the only one. Beyond the Middle East, other global events are playing a role in this oil price surge. Let's take a look at some of these influences. First, we turn our attention to Ukraine. The country's grain exports are resuming following a deal signed in Turkey. This is significant because the conflict in Ukraine had driven food prices up by 17%. Countries in the Middle East and Africa heavily reliant on Ukrainian and Russian grain felt this impact the most. With the resumption of these exports, there's hope for a decrease in food prices. However, this relief is dependent on other factors such as fuel costs, which brings us back to the surge in oil prices. The interplay between these commodities is a clear example of how interconnected our global economy is. Next, we have to consider the demand side of the equation. Oil prices have recently plummeted by 20% due to concerns about weakening global demand in 2024, with China, the world's largest oil importer, at the forefront. This decline came despite the conflicts in the Middle East and production cuts by major oil-producing countries. The global economy is a balancing act, and the scales can tip quickly with changes in demand and supply. Lastly, we should note that the Organization of Petroleum Exporting Countries, or OPEC+, may extend production cuts. This decision could potentially boost oil prices. At the same time, there's the possibility of a resurgence in geopolitical tensions, which could exert upward pressure on prices. So it's clear that this is a complex issue with multiple influencing factors. But what does this all mean for you? The surge in oil prices isn't just a headline. It's a reality that affects everyone, from global economies to individual wallets. When oil prices climb, it's like adding fuel to the fire of inflation. The cost of goods and services increases, and central banks may feel the pressure to maintain high interest rates. This can impact your everyday finances, from the price you pay at the pump to the cost of your weekly grocery shop. But every cloud has a silver lining. A decrease in oil prices could lead to lower gas prices, contributing to a decline in inflation. This might prompt central banks to halt interest rate hikes and potentially cut rates in the future. For you and me, that could mean lower mortgage and credit card costs. And what about the stock market? Well, falling oil prices generally reduce costs for many listed companies, excluding major oil corporations, potentially boosting their profits and share prices. So, while the investor in you might be sweating over oil prices, remember, the game isn't over yet. As we navigate this volatile economic landscape, staying informed is key. So, remember to subscribe for more insightful analysis.